Perfect. What's up, guys? This is Joe with Schematic Solutions. Today, we're going to be diving into literally everything you need to know to catch a 1 to 100 plus risk reward trade. Now, this isn't going to be anything crazy. This is really just diving into the basic aspects of our trading that we use every single day and just ultimately utilizing multiple timeframes in confluence with each other. So let's dive into it. First things first, we have plus or minus about 3 to 7 or 8 confirmations. In all reality, this list is typically around 3 confirmations itself. I usually just use higher time frame POI, compression consolidation, minimum of 3 drives, breakup structure. So in all reality, this is typically like a 6-step confirmation. I did add a couple extra things just to make it a little easier for some of the beginners to really understand these concepts. But yeah, if you already understand these concepts, you understand how to identify a schematic and all of that stuff. But first things first is, what's the flow? What do I mean by what is the flow? Ultimately, we're talking about what is the flow of the market, what is not the order flow, but what is the structure. Now, we can be talking about order flow when we're talking about this. Just keep in mind, order flow is a lesser probability. So ideally, we're going to want to start off either higher time frame or intraday. So let's say this is our higher time frame. For that higher time frame, we're going to want to identify our current high or our current low first. So let's say we are bullish, we're going to want to identify that current high. If we are bearish, we're going to want to identify that current low. Make sense? So since we're bullish, we could see we are definitely in an uptrend. We have our current high right here. Perfect, perfect. Then we want to ask ourselves, what is the high before this current high? Can we agree this is the high before it? It's not this high, because this high was not higher than this high. Perfect. So this is the high before it, which means this is our low maintaining. Now, keep in mind, I'm not talking about bodies, wicks. We use wicks as structure. And if you're wondering why, it's a whole nother video, but ultimately inside of that wick is a candle, right? Exactly. So we don't use candle bodies as structure. We're talking about the actual wicks, in case that was your question. Now, high, low maintaining, we have our structure. It's extremely simple. Step number 2, we want to ask ourselves, where is the money? When we're talking about money, we're simply talking about liquidity, and you can use liquidity to bring you back towards your entry. But to be extremely basic, we're only going to use liquidity for a target. So what is liquidity? Equal highs, equal lows, trend lines, opinions in the market, obviously. And last but not least, every single high and every single low holds liquidity. So let's say there's no equal highs, no equal lows over here, but we have a single high right here. Can we agree this is our liquidity? Exactly. And obviously we'll have lower liquidity points as price comes down, but as of just the higher time frame price action, this is our liquidity. So we have our structure. We understand where our money's at. Now, where are the institutions? And this is ultimately asking, where's the supply and demand? Where are the POIs? Where are the OBs, the order blocks, whatever you call them? I personally just call them point of interest or schematics. Now, that's what we're looking for. We're looking for either that last push down before the push up move. We're looking for our accumulations, our reaccumulations, whatever the case may be. So let's say this was our reaccumulation. If you trade WYCKOFF, you understand that. Or let's just say this is that last push down before the push up move. We're going to identify that point of interest, measure it out, and we're looking for price to get into 50 and or 80%. Now, here's the thing. If 80% is less than a 10 pip stop loss, 50% is less than a 10 pip stop loss, and it's higher time frame structure, I'm willing to place some risk on it. Now, it's going to be very rare that you identify a large move in the higher time frame, and it's going to be less than a 10 pip stop loss. So in that case scenario, what you're going to have to do is wait for a schematic. So what we're going to ask ourselves is, are orders getting filled? As price comes into the area we're expecting institutions to move price away from, are they filling orders there? So what are the confirmations of this? First things first, we want to be in or near a higher time frame point of interest. Step number two, we want to ask ourselves, okay, are we compressing or are we consolidating? Compressing, I would say, is price getting close together. Instead of just falling, is price literally starting to just move closer together, and consolidation is price actually going sideways. Then we want to ask ourselves, do we have a minimum of 3 drives and our breakup structure? I emphasize on minimum of 3 drives because we can have 26 drives. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and our break. Once we get that break, this is our schematic. This is our schematic. So minimum of 3 drives and our breakup structure. 1, 2, 3, 4 drives, and we break. Perfect. So then what we can do, if we really want to identify this schematic, we can, one, identify our trading range, which is just going to be where price spends the most time going back and forth. 2, our trading range is going to be our climax to our AR. If you don't know what that is, check out one of the in-depth Wyckoff videos. 3, we then want to identify that change of character. And our change of character, once again, it's going to be our trading range, climax to AR. But how do we know something's our change of character? So it's ultimately going to be that first deepest retracement relative to the last couple. So if we could see this was our high, this was our high, or sorry, this was our high, this was our low, and then price retrace. Okay, how deep did that retrace? Not too deep. But now we have, this is our high, this is our low. How deep did price retrace? Price almost retraced 100%, right? So that's that first deepest retracement right there, giving us that change of character. Now, our next event that we're going to want to identify is going to be the sign of strength, which is going to be price breaking structure and exiting our trading range. Once we've identified that, we can identify our last drive, measure out 50 and or 80%, and take our limits, if and only if it's worth it. Now, let's say, since we were looking at the higher time frame here, and this is the intraday time frame here, let's say it's not worth it. So as price was down inside of our spring, we scaled down to the lower time frame from the intraday, and we saw this price action. We are in or near that higher time frame POI. Yep. We have compression consolidation. Yep. We have our minimum of 3 drives and our breakup structure. Yep. Okay, perfect. Where's our trading range? So looks like price spends the most time there. It's also that first deepest retracement relative to the last one. Where's change of character? Obviously, we just knocked that out. Where's our sign of strength? Sign of strength, the break of structure and exit of our trading range. Identify the last drive there to there. If it's worth it, place your entries 50 and 80%, splitting our risk. So this could be a lower time frame through a micro time frame. But now let's say we were able to see inside of this spring and scale to an even smaller time frame. inside of the micro time frame, which is the 1 minute through the 1 second, and caught this schematic, are we in that higher time frame? Yes. Do we have compressed consolidation? Yes. Do we have a minimum of 3 drives in our breakup structure? Yes. Do we have our events? Yes, we do. Do we have that last drive? Boom, 50 and 80%. Take your trade. And this entry is how we catch those 1 to 100s, 1 to 50s, in those large R to R trades consistently. It's due to one, the lower time frame, because keep in mind, the lower the time frame, the lower the stop loss is going to be, which means the higher we go, or technically we don't have to go as high to catch that high R to R. But obviously, the higher we go, the R to R is just going to go crazy. Obviously. But this is really how we ensure to catch, or how you can turn a 1 to 20 trade into a 1 to 100. Did you guys catch that? Literally everything that you're doing, if let's say you're catching consistent 1 to 20s, 1 to 30s, instead of catching those 1 to 20s, 1 to 30s, not instead of, still catch those, but then try to dive into the spring and or the test and catch those fractal schematics out of the lower time frame and or the micro time frame. And the reason why I did the micro with dotted lines is because the micro time frame is going to be relatively hard to see sometimes. So it's really something to where you're really going to have to train your eyes with. But this, utilizing higher time frame with the intraday time frame, with the lower time frame, with the micro time frame, and utilizing our basic smart money concepts and Wyckoff confirmations, is how we can catch those 1 to 100s. I really hope you guys got some value from this. If you guys would like to see some chart work, either check into the back test or feel free to lock in for some mentorship. I'll be talking to you guys soon. Have a great day.